Why 2023 is the year of recession? Is 2023 likely to be the year of a global recession? Are we witnessing a slowdown in global economic growth? Are major economies such as the USA, China, and Europe experiencing a decline in their growth rates? What factors are contributing to this situation? Moreover, what measures are these major economies taking to address and improve the situation? In this video, we will delve into these topics and explore the current state of the global economy. So, without any more delay, let's dive right into the video. When leaders from around the world gathered at the World Economic Forum in Davos recently, they learned some worrisome news about the economy. A report from the WEF showed that 2/3 of economists surveyed believe that there might be a global recession in 2023, meaning that the world's overall economic output could shrink. In January, the World Bank also warned that the global economy was at serious risk of falling into a recession. This is concerning because major economies like the United States, China, and Europe are showing signs of slower growth, which adds to the possibility of a global recession. The World Bank's estimates for global economic growth are 1.7% in 2023 and 2.7% in 2024. China, as the world's second-largest economy, has a significant impact on the global economy. However, there are several challenges currently affecting China's economic growth and overall functioning. Firstly, China's zero-COVID policy has acted as a barrier, limiting economic activities. Additionally, the country is facing a crisis in its housing market. These events, combined with the government's difficulty in managing them effectively, have created a negative impact on the Chinese economy. Europe's economy is slowing down, with rising inflation leading to citizen protests. The energy crisis caused by the Russian-Ukraine conflict and dependence on Russian gas imports has further affected economic growth. Projections suggest high inflation will persist in 2023. In the U.S., the Federal Reserve increased interest rates to 4.5% to 4.75%, and there was a contraction of 0.9% in the GDP during the second quarter of 2022, followed by a 1.6% contraction in the first quarter. These indicators suggest a potential recession in the economy. The International Monetary Fund, or IMF, recently provided a relatively less pessimistic outlook, suggesting that the global economy may be able to avoid contraction this year. However, the IMF also predicted a shrinkage in the United Kingdom's economy and cautioned that the United States has a limited path to escape a recession. According to the IMF, along with the World Bank and other experts, a significant factor driving the economy towards a recession is the sharp increase in interest rates by central banks to combat rising inflation. This dilemma raises the question, do we have to choose between soaring prices and a recession that itself leads to substantial job losses, as evidenced by the termination of over 100,000 tech workers in January alone? In times of economic crisis, do individuals essentially face the trade-off between affordable fuel and stable employment? In simple terms, bringing down inflation is difficult and can slow down the economy. However, it is important for central banks because high prices impact the poor the most. The somewhat good news is that Europe, despite facing issues like Russia's war and energy shortages, may be showing how to control inflation without causing a recession. Explaining interest rates. Central banks have the important task of maintaining stable prices in an economy. They achieve this by controlling the amount of money and credit available in the system, primarily through adjusting interest rates. When interest rates are low, it encourages borrowing, stimulates economic activity, and supports growth. However, during the COVID-19 pandemic, central banks faced the challenge of rising inflation due to increased consumer spending. To tackle this, they raised interest rates to make borrowing more expensive and reduce excessive demand. In recent times, there have been significant interest rates increases by central banks worldwide. The U.S. Federal Reserve raised rates by 4.5 percentage points, the European Central Bank by 2.5 percentage points, and even higher hikes were seen in countries like Brazil, 11.75 percentage points, and Sri Lanka, 10 percentage points. The objective behind these hikes is to decrease consumer demand, encouraging people to postpone major expenses such as buying a car or going on vacation. However, this monetary policy approach is considered a blunt tool that affects everyone by increasing borrowing costs for households and businesses. Nevertheless, increased interest rates can also lead to adverse consequences, such as companies reducing investments and downsizing their workforce. Varma explained the simple economic logic behind curbing inflation. Higher prices lead to demands for better wages, which, while beneficial, increase expenses for companies. This, in turn, prompts firms to raise the cost of their goods and services, creating a negative spiral. Unfortunately, the poorest individuals with limited bargaining power and inadequate savings are hit the hardest by this cycle. Central banks' response of increasing interest rates to curb demand ultimately results in an economic slowdown or recession. Economists expect continued rate hikes, leading to a global economic slowdown or mild recession. According to Radhinka Pandey of NIPFP, the U.S. Federal Reserve intends to increase borrowing costs until job vacancies decrease or signs of an impending recession become clearer. Recent data reveals that job openings in the U.S. reached a 5-month peak in December, indicating a robust labor market. However, Pandey highlights that inflation continues to be high. The IMF projects a decrease in global inflation from 8.8% in 2022 to 6.6% in 2023, yet it will remain above pre-pandemic levels of 3.5%. Throughout the past 50 years, with the exceptions of 1975 and 1982, the global economy has experienced recessions in 1991, 2009, and 2020. Economists warn that even if a recession is avoidable in 2023, a significant economic downturn will still negatively impact millions of workers worldwide. And that's all. What are your thoughts on the slowdown of the global economic growth? Must share your thoughts in the comment section.